Today, property investing in uncertain times. Hello again, it's Martin North from Digital Finance Analytics, one that is posts covering finance and property news with a distinctively Australian flavour. Today, I'm joined by George Markoski. Hi, George.
Hi, Martin. Good to see you again.
Yeah, great to have you back on once again, and interesting times to talk about property investing, given everything that's going on. So great to have you back on the channel again. Let's start from the top and just get a sense of what's your read at the moment with regards to the property market, and particularly property investors. I notice a lot of apartments are coming on at the moment for sale, despite the fact that houses less so with the COVID. So interesting times.
Yeah, interesting times. Well, I suppose a lot of apartment people that are building them are gearing up for the massive immigration we're about to get now that the borders are open. So it's been earmarked that we're going to start getting 250,000 people moving back into Australia. And the ratio is when you have 3 immigrants come to Australia, you need 1 property. That's the normal ratio. So there's a lot of developers in Sydney and Melbourne getting ready for that.
Okay, so interesting. So what you're saying basically is that there is a tsunami of new purchasers coming in thanks to the change in migration, and that's going to basically push property prices up and push demand up?
It is. Well, look at what happened in COVID. So what happened during COVID? And look, most people were surprised about COVID because, even myself, I thought there was going to be a bit of a blip, and there was a small little adjustment. So normally when you've got a financial crisis or some sort of crisis like a pandemic, property prices, hard assets drop and they go down. And it's like a V shape. So what happens, they go down and then they come back up. So I expected a V-shaped recovery, but this V-shaped recovery was very sharp. It sort of like went down and just bounced straight up again really quickly, super quick.
Right, but interestingly, of course, it's not necessarily behaving like that in all sectors of the property market. I mean, for example, let me take high-rise apartments in North Ryde, right? They're down about 21%. Compared with where they were in 2017, right? Now, If I compare that with some other areas where property prices and apartment prices are much more stable. So it does actually beg the question, are all areas going to behave the same way? And do high-rise and low-rise and houses behave the same?
Good question. And no, they don't. And that's because there's a fundamental thing called supply and demand. And when you've got too much supply and not enough demand, property prices go down. When you've got more demand and less supply, property prices go up. So when you've got your little investor's hat on and you start thinking about supply and demand, then what can happen is you can look at different categories of property and they look different. And, in general, high-rise apartments have always got too much supply, less demand. And that's just a fact, and it's been going on for a while. And I started talking about this back in 2007 about the high rises going to be dropping. They dropped, and I said they're going to drop again, and they have. And look, we might get a small recovery, but they're not going to be as robust as what has happened because there's a lot of economic and social changes that have happened as well, which can affect them even more. Now people don't need to live in the city and go to work anymore like they used to. So high rises are really only exciting to immigrants because Australians don't like them anymore.
Right, so that's very interesting. So, and we've seen this in our survey. So we've seen, for example, a lot of vacancies in, if I take Melbourne 3000, Melbourne 3006, in and around the centre of Sydney as well. Vacancy rates are very low. In fact, I was speaking to somebody the other day who's got 6 vacant apartments in high rises. They haven't been able to let them for the last few months. And that's because there's no demand. Now, that demand may come back. But even if that demand does come up, and you talked about migration coming in, that's not necessarily going to be strong enough to turn the apartment market around in those areas, is it?
Look, I personally, at the end of the day, when it comes to property, you want to go with a winner. And I really think personally, I just don't like apartments, and I never have because of the oversupply. There's a very rare time where, every now and again during a boom, apartments go up in value and then they've usually slumped. But most The people that make money out of apartments are the people that build them, not the people that invest in them.
Well, the people who build them, and of course the local authorities that actually give the building approvals, right? Because if you look at the cost structures of construction, particularly in high rise, actually the local authorities do quite well as well.
Exactly. And you've got a lot of people like Trigonoff, who has earmarked a pile of big apartments that he's building right now. And you've got these big developers out there, and they're just smashing out these big apartments, and they want to do that and make their money out of the immigrants coming in. Me, I don't like apartments. I don't think it's the future, because urbanisation is now going to urbanisation 2.0. We're living differently. People are talking over Zoom. They're working from home. Actually, funny enough, in England, I've got a lot of business friends in England. In England at the moment, a lot of people that wanted to come back to work, businesses said, don't come back, stay home, because you're actually doing a better job at home. They're getting more value. And on the average person, if you don't work, go to work and work from home, you're saving $15,000 a year in Australia on average. But not only that, you're saving the commute time. And I mean, you look at Sydney and Melbourne. I know people in Sydney and Melbourne. When I used to live in Sydney, I knew people at work that commuted for 2 hours each way, each day, which is crazy.
Well, it's interesting because I used to commute when I was in the UK from into London. You know, that was 2 hours there, 2 hours back. Came to Australia and loved not having to do it. And then I discovered that more and more people were being forced to live further out because of the price differential. But as you say, you know, the revolution now with digital and with everything else is really changing the name of the game. So if I think about property investing, then, and you know, if somebody was thinking of property investing for the first time, it sounds to me as though you'd ignore high rise, you'd probably look at low rise or houses. Are there particular areas that you think, therefore, from what you're seeing, makes more sense?
Yes, absolutely. Look, there's two types of way, and we spoke about this last time. There's fundamental and statistical sort of way of looking at properties. And when you look at the market, there's 16,000 markets in Australia that are all slightly different. And those markets, there's going to be a percentage that are winners and a percentage that are losers. And what I find is, if you go and look at the ones that have got the biggest demand and the least supply, they're always going to outperform any other properties, regardless of what type they are. But normally, you know, a house or a townhouse is going to have a lot more demand and less supply, just because of the sheer fact you need land to build these things.
Right.
Yeah.
And the point there is, you know, and I often preach this gospel, I'll preach it again, you have to go granular, you have to look at individual locations, individual types of property. You can't take these generic averages and generic price moves and things as anything useful, right? Because it doesn't really help.
Look, what the macro picture sort of helps you to go down and look at where you're looking at, but then you've got to look individually. Yeah, absolutely, definitely.
And what sort of time frame, you know, if you're talking to property investors, and you've been in the property investment game for a long time, what sort of time frame should people be thinking about? Because I hear of people saying, well, you know, I'll buy a property investment property, and next year I'll have made money, and then I'll you know, do it again. But is that realistic?
That's hilarious. Look, if you are going to invest in property, you really got to look at long term. You look at the statistics, and the chance of you failing in property after 1 year is very high. After 10 years, it's almost impossible. And so basically what happens is, the longer you're in property, the more chances you've got of winning, because it averages out. Because property prices don't go up every single year at the same time. They stay flat, and then they suddenly spike and they go down. So the key to property is you buy them as soon as you can and hold them for as long as you can. And that's the thing. It's all about time in the market, not time in the market.
Okay, and that's really important for people to understand, right? Because the number of times that I see people looking too short term is just quite astonishing. The other question people ask me often is about negative gearing. You know, is it good to leverage up and let the debt do the work for you? What's your perspective on debt and property investing at the moment?
Yeah, good question, because there's two types of gearing. You've got negative gearing, positive gearing. And negative gearing is bad because you're losing money in order to try to make money in the future. And positive gearing is bad because when you get a property that's positive geared, it's not likely to have a capital growth. And that's the reason, because not many people are interested in it, so therefore you're getting a better return. Because the return actually shows you how much people are willing to pay extra for a property, and that's what reduces the return. That's why you look at Melbourne and Sydney have got the smallest returns out of all the cities, is because they're more popular. So I've got a hybrid. I like to do, and this is the difference between the struggling investors and the wealthy investors. And the fundamental part is most people, the biggest expense is tax. You look at the average person, tax and super comes out of your pay, and then you use post-tax dollars to do your buying, which is really not the way the rich do. So you look at Robert Kiyosaki and myself and other investors, what we do is we actually lose money on paper, but make it in real life. So I've got a thing called negative gearing, positive cash flow. So if you get the right property, the right return, you can actually structure it the right way where every year you're losing money on paper, but every week you actually get money in your pocket. And that's the best way, negative gearing, positive cash flow. It's a new hybrid that I've sort of created.
And you mentioned Robert Kiyosaki. Of course, you're going to run a seminar with him on the 22nd, and it's a free seminar. We'll put the links and things below, because he and you have a very interesting perspective in terms of how to think about investing now in these uncertain times, and why it is that property should still be on the radar. Look,
Robert Kiyosaki, he's wrote his book in the 90s, and he's been around for a long time. And one thing about Robert, because he understands the fundamentals of investing and wealth creation, he's still relevant today because the fundamentals don't change. The market may change, the situation may change, but the fundamentals are the same. And I think what we want to do is teach people the fundamentals, so that way it doesn't matter if property is going up or down, you can still actually create wealth if you have the right structure and the right fundamentals in place.
Yeah, and I spoke with him the other day, and he said, you got to think about who you get your lessons of life from, right? Because there are a whole bunch of people out there saying quite different things at the moment with regard to what's going on, all the uncertainties, all the quantitative easing, etc. So you got to pick your tutors and pick your life lessons, etc.
Yeah, look, I've been investing for a long time, and I've learnt from making mistakes, and when I use my fundamental system now with the way I do things, it makes property investing simple. Not easy, because everything when you get out of comfort zone is hard, but it is simple.
And what about the view that property prices have gone very, very high over the last year or so? In fact, most people have made more money from the theoretical paper value of their property relative to the income they might have earned, working. How do you square that circle?
Yeah, good question. I mean, property prices have averaged around 22% over the last year in Australia, and that's quite a big bump. It's massive. But we've had bigger bumps in the past. And the fact of it is, a lot of people now are saying we're in a property bubble and it's about to crash. And I hear this mantra over and over and over again. I've been hearing it since I started investing for, last 25 years. And I don't buy it, because what I've noticed with property prices, one thing is, if you don't have any property, you can't make money out of property. That's one thing. And there's people saying we're gonna have a crash, They're stopping people from investing. And then if you don't invest, you can't actually make money if you don't invest. Now, is it going to be challenging? Yes, because we're in a very interesting time, because we've had a massive recovery. And then people are thinking, what's going to happen? Is there going to be a correction? Is there not going to be a correction? And what I'm saying, if you get your fundamentals right and you're looking long term, it doesn't actually matter. That's the key, because I don't believe 22% is very big jump anyway. And what's happened, if you look at Sydney and Melbourne, they've already had a correction recently, and they're actually correcting. So property prices have dropped a little bit already in Melbourne City because they're overheated. And last year, the market was crazy. And the reason it was crazy is a lot of people were uncertain about putting their properties on the market. And because of it, there was a lack of properties. And when there's a lack of supply, the demand goes up and people start going crazy. Now, I've got a team on the ground looking for property for our members, because we've got a buyers group. And what we've noticed now is things are changing slowly, which is great, because, until now, developers were going crazy, and we were having clients literally buy a property, and in 2 weeks' time, it's worth $90,000 more, even before they settle. And look, and I'd love to say, wow, you can join our program and you can make 90 grand in 2 weeks, but you can't. This is just an anomaly. And personally, I don't like it. I prefer getting the constant 7% per year over the 10 years, where it's very constant. You know what's happening, and it's nice and easy. But when you look at it, you really got to think, okay, what are we going to average? and we're not going to average much more than 5 to 7% over the next 10 years. That's the fact of it. Is there going to be correction? Maybe. But if you buy and hold for the long term, you will make your money.
And I guess the final point here is, of course, a lot of people have got significant amounts of debt because of, that's the way it works. Interest rates, if they start to go up, does that change the game, or is there still sufficient insulation inside those property investors' portfolios to be able to handle higher interest rates?
Look, good question. And a lot of people are saying there's going to be mortgage stress, and I keep hearing this bandwagon going around. There's quite a few Australians, a very large percentage, I don't have the figures on me, that actually own their home outright. When it comes to mortgages, our mortgage repayments, if you look at the data out of your weekly pay packet, it's never been this affordable since the 1980s. So when I look at property price, I don't look at the price of the property. I look at affordability out of people's take-home pay, because that's the important part. Because it doesn't matter if I'm buying $1 million property or $10 million property. What matters is how much money do I have left each week to live after I pay for this property. And if you look at that, the affordability at the moment has never been better. And I really think because of that, whenever I see affordability, that makes me look at price and think, wow, they're cheap. They're still cheap. Because back in the 90s, I was losing $300 or $400 per property with the interest rate and with how much they were compared to my wage compared to now. So I'm buying property now and it's positive gear. I'm making $100, $200 a week. And then back in the 90s, I was losing $300 or $400. So even though they were cheaper, because I was buying properties for 150, 200,000 then, and now I'm buying properties for 450 or 400,000, 550,000. But that $550,000 property is cheaper because it cost me nothing.
Right. And interestingly, of course, because I run mortgage stress analysis, and I've always said that there are some people doing okay, that there are others that are doing less well. And in fact, you can go down into granularity and see there are certain suburbs where a lot of people are in difficulty, less so elsewhere. The question, of course, is, well, how high will interest rates go? How quickly will they go? And how does that change the game? I'm not sure anybody quite knows. The RBA will sit on their hands for as long as they can, but if the Fed puts the rates up a lot, that probably will ultimately flow through. But it just make the point, doesn't it, that there are lots of different elements that you need to think about when you think about property investing. You need to think about the property, the location, the demand, supply, the interest rates. This isn't actually a simple way to make money, is it?
Look, I personally think it may not be simple. Well, look, if you get the right mentor and the right system, it is simple because it's color by numbers. But if you try to do it on yourself and try to become an expert, you need to, they say, Malcolm Gladwell says you need 10,000 hours to become an expert in something. And that's if you do it successfully. So if you want to be a property investor, you really need to spend 10 to 20,000 hours to become good and do it. And if you haven't spent 10,000 hours, and you think you're better than someone else doing it, you're going to get in a lot of trouble. Or you need to find someone that's had 10 or 20,000 hours to help you.
Exactly. George, well, I appreciate your time today. Just to re-emphasise again, that conversation with you and Robert is on the 22nd of January. It's a free seminar. We'll put the links and things below. I think it'll be really interesting to hear you and he debating some of these issues, particularly in these uncertain times. And I appreciate your time today.
Thank you so much. Really enjoyed it. And have an awesome day.
Thank you. See you later. Cheers. Bye-bye.